You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, today we are going to look at another earnings trade. We have an extremely busy week in earnings coming up next week. So we got a lot of interesting stocks to talk about last week, including in the FANGs, we got Facebook, Google, Amazon, to name a few. Let's toss Visa into the mix. They're going to be announcing. We got Apple coming up. Even throw McDonald's in there. Let's get a couple of more high-priced stocks. And, yeah, it just makes for a very eventful earnings. MasterCard, that's another one I'm seeing on my list. So let's start by looking at kind of a FANG stock, if you will, Microsoft. It gets bunched into the FANGs. And we're going to look at a trade in Microsoft. But before I get there, last week I promised that we would talk a little bit about Boeing. And we looked at Boeing. We said, let's do a butterfly because Boeing is going to be announcing earnings. And we've had a lot of fun with Boeing in the last few editions of Options Playbook Radio. We looked at a long straddle well before earnings. We looked at a time spread that's going into earnings. And ideally, that trade would still be alive because what we looked at doing was selling an expiration that was quite a ways away from earnings. In other words, it was going to expire a couple of weeks before the earnings event, and then buying an expiration that was going to expire after the earnings event. And earnings in Boeing is going to be on the 24th of this month, and it's going to be announced before earnings, so about a week away. And I should throw in that we are taping Options Playbook Radio on Wednesday, July 17th. The markets are closed right now. And we're going to look at the butterfly that we looked at last week. And I find it, once again, on Options Playbook Radio, everything we do is not meant to be a recommendation. We're just trying to learn. And why I think that it's real interesting and why I think we definitely want to cover it is we talked about, well, let's put this trade on. We can get a fairly inexpensive call butterfly because we were dealing with the July 26th expiration, which is 2 days after the earnings, and we already had a pretty decent amount of increase in implied volatility. So we went out, and the stock was at 352 approximately, and I'm going to round off here. And we bought the 360 call, sold 2 of the 375 calls, and bought 1 of the 390 for a 15-point wide butterfly and the total cost of it was $2.70 or $270 plus commission on that trade. So relative, if you just bought the 360 call outright was trading for $5.25, and that was about 8 points out of the money when we were looking at doing the trade, and we were able to do this entire butterfly for $2.69, about half price. Now, we said on the call that if the market moves towards that middle strike, that's okay. We'll just get out of the trade. And we actually did kind of a quick estimate and said, well, if it gets there, if we look at the money now, it could give us an estimate as to if it goes to our short strike, what it might be worth. And I think we said somewhere around $5. I don't remember the exact number. But lo and behold, guess what has happened? The market has moved, and it has moved very close to the short strike. Today, Boeing is at 369.52. We're going to call it 370 to make life easy. It's up $6.77 on the day. And that's right in between our 360 call that we bought long and our 375 call that we sold short. And right now, it's showing that the midpoint of the trade is $4.80. So, what would I do in Boeing? I'd get out. Why wait around for earnings and have the risk of that earnings and wait another week for that to happen? Because of this, you're up $2 on the trade. You don't have any earnings risk at all. And that was we said that it should be around 5 or 5.25, somewhere in there, just over $5, if it got all the way up to the actual short strike, by just making an educated guess based off of the option chain on the day that we put the trade on. So I thought it was fun to note that educated guess seems to be fairly close, because we did actually have the market move the way that we wanted it to. We started moving towards that short strike. So I would just close the trade out. I'd get out of the trade. I would move on. Part of the reason why we did this trade a week early, too, we said, well, a lot of times we'd want to put this butterfly on the day of the event. That's, so basically they're going to be announcing on the 24th before the open, so you do it on the 23rd. But we don't mind doing a butterfly because it gives you some options, because you could roll it into a short spread if it went against you, because there's just so much premium that's generated by a $370 stock going into earnings and implied volatility becoming elevated. All right, so we'd be out of that Boeing trade. Okay, so now let's also look at the long calendar trade that we were talking about. Now, let's set the stage. This was a few weeks back, I'm guessing it's about 20 days ago that we taped Options Playbook Radio. We had a successful long straddle on Options Playbook Radio, and we talked about doing a long calendar spread, and basically we're saying, well, we just did something that was looking for some news and looking for a big move, and that happened to work out. And now let's just say, well, going into earnings, Boeing might slow down. So when we did the trade in the beginning of July, we looked at buying a 375 strike July 26th call, which contained the earnings, and selling that same strike July 12th call. Well, the stock did go down, and we said that's all right. We're not too nervous about that. And the main reason why is we don't mind being long a call going into earnings, and we want to get it done for a much cheaper price. Well, that 375 strike call that we bought at the time was trading for $12 approximately, and just a real expensive call. And we said, if anything, we just get long a call going into earnings at a much cheaper price. Well, the short-term call was trading for a lot less. The entire trade was done for about $4.75 at the midpoint. So once again, we have a very interesting pricing scenario that has happened. That July 12th call would have definitely expired worthless unless you did a trade on it or whatever. And when it expired worthless, the stock started creeping back up. And guess what? Boeing right now is trading at 369.52, almost back to the 375 that it was at when we put the trade on. The July 12th call has expired. It would have expired worthless if you just would have let the trade ride. And now our 475 call is trading for $4.75. Basically, the exact price Well, I can actually, here, let me give you the exact price to get quoted on it. So 1 second, let me pull up a quote on that option contract. So the July 26th expiration, 375 call with the markets closed on Wednesday, July 17th, is trading for 470 by 485. 470 by 485. So we've just had a couple of odd things that are happening in Boeing because we talked about events that could happen, and both of them have happened. And so just interesting going into Boeing with the trades that we've done. I definitely would have got out of the butterfly today. I'd rather close that out than ride it another week and go into earnings. And now we did the long calendar spread, and we paid $475 for it. We were dead wrong on the trade, but guess what? Now it's trading for $475. And if you'd like to, you can get out of the trade and say, I don't want the cheese anymore, just let me out of the trap. Or we ended up paying basically par value for what that call is worth right now, but we just did it about a month ago. We had an opportunity back then, and now at this point in time, we could be just long that call going into earnings. All right, long-winded on Boeing, but Boeing's just been an interesting underlying to trade, and I mentioned it last week. It's an expensive stock, which adds premium. There's been a lot of news on it, but you don't know when the news is going to happen. The stories have been good. They're getting more orders for planes. Then the story's bad because the planes are going to be, the ones that they've had problems with are going to be grounded for longer, and it's just been back and forth. So it should be a real interesting earnings for Boeing on the 24th, and they're going to announce before the market open. All right, let's now get back into Microsoft. So if we look at Microsoft, the paper trade that we have for the week, and I'm going to emphasize this once again, nothing's meant to be a recommendation on Options Playbook Radio. As a matter of fact, we probably do too many strategies because our whole goal is just to find different scenarios that a specific strategy would work. And it is earnings season, so I feel like we should talk about earnings. We're going to do Microsoft because it's really going to kick off the FANG stocks. We had Netflix actually announced today, and it's down quite a bit for a couple of reasons. First of all, their subscribers, they missed their number there, and it looks like they didn't do very well on earnings, and the stock is down big in the after hours. So we're going to look at Microsoft, and we're going to do something different that I don't think we've done around earnings yet. We're going to look at an iron condor, and I kind of wanted to find a stock that we might do an iron condor on, and Microsoft seems to fit the pattern. Out of the FANGs, and I'm going to say this, with a smile on my face, it's one of the less volatile of the FANGs, I would say. Not on an implied volatility level, but I just think that Microsoft in general is a little bit more stable than earnings and Google and Amazon and numbers, et cetera, et cetera. It's done extremely well, and it's overall, for the last couple of years, you couldn't go wrong by buying shares of Microsoft. So we're going to look at a more muted view on what could happen after earnings. So before we get too far along, we have to look at the expected move. That's a big deal on earnings. But we're going to try to sell some premium, and our whole goal here is our forecast would be that we think Microsoft will move less than the expected move as opposed to more. So we're hoping that it will stay within a range. So Microsoft is going to announce earnings on 7/18, which is tomorrow after the close. We're taping Wednesday, July 17th. The markets are closed. Microsoft today finished at $136.27. It is down 81 cents on today's trading. So the expected move is approximately $5. The implied volatility is about 51%. $5 on a $136 stock is about a 3.5% move. We're going to make sure that we get wider than that $5 expected move. And that means what the iron condor is going to be is we're going to sell a call credit spread above the market, and we're going to sell a put credit spread below the market. What's going to be driving this trade and where the risk comes from is the short call and the short put. We're going to go about equidistant out of the money. We have no opinion on if they're going to be good or bad as far as the earnings are concerned. And we're going to, on the downside, sell the 130 call option, and we're going to go out a little bit farther in time. We're not going to take the complete risk of the earnings. We're going to give ourselves a little bit of time premium in case we're wrong and allow us to trade out of this trade. That time value will. So we're going to sell the July 26th expiration, 130 put, and then buy as protection the July 26th expiration, 128 put. Now, that's approximately $6 out of the money, a little bit more than the $5 expected move. And on the upside, we're going to do something very similar. We're going to sell the 143 strike call, and then we're going to buy the 145 strike call for protection. That, if you do the math, is just over 6 points out of the money also. So we're about equidistant out of the money on the call side and on the put side. And what's so fun about Iron Condors overall is that you get to bring in two credits, and you also know that one side is going to be correct. The market, in theory, can't go up and down at the same time, so either one side of this trade should be profitable. So with all that said, we can get this done for a net credit if we can fill at the midpoint. Midpoint fills aren't always assumed, but if we could fill at the midpoint, it would be a 60-cent net credit to the account, less commissions, of course. And that also means we're doing this 2 points wide. So by the fact that we can bring in two credits lowers the overall risk of the trade. And that means that we get those two credits, and it's 2 points wide on the put side, 2 points wide on the call side. So the total risk of this trade is 60 cents minus that 2 points, or $1.40 on the trade. And don't forget to add in the commissions there too. So another fun thing about Iron Condors is the actual brokerage firms know that you can only lose on one side at expiration, so because of that, they only hold out the margin requirement for one of the spreads. And in this instance, since they're both 2 points wide, the margin requirement would be $200, and then, of course, you get that 60-cent credit that you bring in. So the total that you got to put up for the trade is $1.40. Okay. So we're doing this Iron Condor, and I'm going to do it on a stock that's a little bit more risky overall. You can just take a shot and do it with the July 19th expiration. So they announce on the 18th after the close, and you got one full day of the trade, and either you make it or you don't. But I don't like that scenario. Even 1 week's worth of time on a $136 stock, even though implied volatilities are going to come in, that will give you the opportunity to trade that underlying, to try to protect yourself. Either you can, if it goes to the bull side, you can close the put side and then try to adjust the call side. The fact that you have another week's worth of trading, if it just gets to a short strike, you can close it out. That you can do that quickly. And hopefully you can save yourself a little bit of loss on the entire trade by moving it again, by acting quickly. So overall, I like to add another week if I'm doing Iron Condors. If I'm doing short spreads, I'd prefer to do that because I want to have the opportunity to adjust a trade, especially around an earnings report. Okay, so let's just recap the trade overall because there was a lot to be said. We have Microsoft trading on Wednesday, July 17th. The markets are closed. It's a $136.27 stock. It was down 81 cents on the day. We're going to go out to the July 26th expiration. We're going to sell a call spread and a put spread at the same time, making an Iron Condor. We'll be selling the 143 strike call and buying the 145 strike call, and at the same time selling the 130 put and buying the 128 put. We're going to do this for a net credit of 60 cents to the account. That will be our max upside, less commissions, of course, and our max risk will be that 60 cents minus 2, or the width of the spread, or $1.40 less commissions, plus commissions on the risk side. All right. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.